Current market status. Closed. The U.S. stock market is currently closed for the weekend as of Sunday, December 7th, 2025. The last active trading session concluded on Friday, December 5th, 2025. At the final bell on Friday, SoFi Technologies Inc., trading under the ticker symbol SoFi on the Nasdaq, closed at exactly $27.78 per share. This figure represents a significant intraday decline, with the stock sliding $1.82 from the previous close, marking a sharp downward move of 6.15% for the session. The trading volume was absolutely massive, clocking in at over 138 million shares exchanging hands, which is substantially higher than its average daily volume, indicating intense selling pressure and heightened investor attention. During the session, the price fluctuated between a low of $26.93 and a high of $27.93, failing to reclaim the $28 level before the weekend. The expectation for SoFi leading into this week was nothing short of euphoric. Investors were riding high on a wave of momentum that had seen the stock nearly double over the course of the year. The narrative was widely accepted. SoFi had finally turned the corner, achieving consistent GAAP profitability, crushing earnings estimates, and potentially positioning itself for inclusion in the S&P 500 index. The retail crowd and institutional backers alike were expecting a victory lap, a quiet consolidation period, or perhaps a push toward new all-time highs above $32. The reality, however, hit like a bucket of ice water. Instead of a calm drift higher, the market was blindsided by the company's announcement of a massive $1.5 billion capital raise through a convertible notes offering and common stock issuance. This move, while strategic for the long-term balance sheet, triggered an immediate and visceral reaction: dilution fear. The reality is that management is taking chips off the table and raising capital while the stock price is elevated, a classic corporate finance move that often punishes existing shareholders in the short term. This tension between the expectation of a continued unblemished rally and the reality of a sudden dilutive capital raise is the defining story of the moment. It forces every person holding this asset to ask a difficult question. Is this a sign of weakness, or is it the ultimate war chest being assembled for an acquisition that could change everything? Let's look closer at the immediate aftermath of this announcement. When a company like SoFi, which has been performing exceptionally well fundamentally, decides to dilute shareholders, it creates a psychological rift in the market. The massive volume we saw on Friday, 138 million shares, tells us that a lot of weak hands folded. They saw the headline $1.5 billion offering and immediately hit the sell button, fearing that their equity slice was shrinking. But who was on the other side of those trades? To have 138 million shares sold, you need buyers for 138 million shares. The stock stabilized around $27, refusing to collapse completely toward the mid-20s. This suggests that while retail traders might be panicking over the dilution headlines, larger players could be stepping in to absorb the liquidity, viewing the drop as a discount on a high-growth asset. The core of this recent movement is tied directly to the specifics of the offering. By issuing convertible senior notes and common stock, SoFi is effectively strengthening its capital ratios. In the banking world, capital is king. With the regulatory environment shifting and interest rates in late 2025 starting to come down, having a fortress balance sheet allows a bank to lend more aggressively when competitors are pulling back. So, while the immediate reaction is dilution is bad, the contrarian take here is that Anthony Noto and his team are preparing for a massive expansion phase. They are raising liquidity not because they are desperate, but because they are opportunistic. They are selling shares at $27 plus rather than at $15, which is a prudent move for long-term sustainability, even if it hurts the stock price for a few days. Now, let's widen the lens to the fundamental picture that supports this stock. We cannot ignore the backdrop of the Q3 2025 earnings, which were nothing short of spectacular. The company reported record-adjusted net revenue of $962 million, obliterating estimates. More importantly, net income surged to $139 million. This is not the unprofitable, cash-burning fintech of 2021. This is a GAAP-profitable, diversified financial powerhouse. The membership numbers are equally staggering, with total members growing 35% year-over-year to 12.6 million. They are adding nearly 1 million new members a quarter. This growth engine is fueled by what they call the financial services productivity loop, where a user joins for a high-yield savings account, then takes out a personal loan, then opens an investment account, and eventually gets a mortgage. This brings us to the competitive landscape where SoFi is carving out a very specific niche. When you look at the broader market for online investing and individual brokerage services, the field is crowded. You have legacy giants and nimble disruptors. Take Fidelity, for instance. Fidelity Investments has built a reputation over decades. Their strength lies in Fidelity Wealth Management and their deep roster of Fidelity mutual funds. A user who goes to Fidelity is often looking for stability, access to Fidelity ETFs, and perhaps a more traditional banking relationship. The Fidelity trading platform is robust, and the Fidelity mobile app is functional, but it often feels like a legacy tool adapted for the modern age. On the other end of the spectrum, you have Robinhood. The Robinhood stock trading experience is gamified, sleek, and hyper-focused on the active trader. Robinhood app users are often there for Robinhood crypto or to trade Robinhood fractional shares with zero friction. Robinhood investments appeal to a younger demographic that wants instant gratification. The introduction of Robinhood Cash Management tried to bridge the gap to banking, but it still feels primarily like a trading venue. Then you have Interactive Brokers. This is the heavyweight champion for professional traders. The Interactive Brokers' trading capabilities are unmatched in terms of global access and order execution. The Interactive Brokers platform is complex, designed for those who know exactly what they are doing. Interactive Brokers stock trading is about low margin rates and low Interactive Brokers fees, appealing to the sophisticated investor who manages their own hedge fund-style portfolio. So, where does SoFi fit in? It sits right in the Goldilocks zone. SoFi Invest isn't trying to be the most complex tool like Interactive Brokers, nor is it trying to be the hyper-gamified tool like Robinhood. It is positioning itself as the only place you need for your entire financial life. Unlike Schwab Intelligent Portfolios or standalone investing sites, SoFi integrates the investing piece directly with high-yield savings and lending. When you use SoFi Active Investing, you're often moving funds instantly from a SoFi checking and savings account. The SoFi Robo-Advisor product is designed for self-investing without the headache. It captures the user who realizes that invest online shouldn't mean trade alone. They offer investment help through access to certified financial planners, something you rarely get for free on other platforms. This integrated model is why the institutional activity we are seeing is so fascinating. In the third quarter of 2025, we saw massive inflows from institutional giants. JPMorgan Chase increased their position by an eye-watering amount, adding over 42 million shares. BlackRock also upped their stake significantly. When you see entities like JP Morgan, who are arguably competitors, buying up shares of SoFi, it signals that the smart capital on Wall Street validates the business model. They see the transition from a niche student loan refinancer to a top-tier national bank. The drop we saw on Friday might shake out retail investors, but the data suggests that institutions have been accumulating this stock aggressively in the 20s. Let's pause for a second and engage with this idea. I want to hear from you. Comment below how many shares of SoFi you currently hold, and more importantly, did you buy more during Friday's dip, or did the dilution news scare you off? I am genuinely curious to see the sentiment of the retail holder versus the institutional data we are seeing. Moving back to the analysis, we need to discuss the tech platform segment of SoFi, which often gets overlooked. This consists of Galileo and Technesis. These are the underlying infrastructure layers that power other fintech companies. Think of this as the AWS of fintech. While everyone focuses on SoFi stocks and SoFi ETFs available to consumers, the B2B side of the business is building a moat that is incredibly difficult to cross. As more banks and fintechs move to modern cloud-based core banking systems, SoFi gets paid. This segment saw revenue acceleration in the most recent quarter, proving that their strategy of diversifying revenue streams is working. They are not just reliant on interest income, they are generating massive technology fees. However, we must address the risks. The expected was that interest rate cuts in late 2025 would be a pure tailwind. Lower rates mean lower cost of funding for SoFi and higher demand for loans. The reality is a bit more nuanced. While rate cuts help, they also compress the net interest margin if not managed correctly. Furthermore, the personal loan market is showing signs of normalization. Credit quality has held up remarkably well for SoFi compared